Section 1.1. What is FIRPTA? History and purpose. Introduce FIRPTA, Foreign Investment in Real Property Tax Act of 1980 and why the law was enacted. Origins and enactment, 1980. Enacted as part of the Omnibus Reconciliation Act of 1980, FIRPTA was Congress's response to growing concerns about foreign investors purchasing U.S. real estate and not paying taxes on the capital gains when selling these properties. The Omnibus Reconciliation Act of 1980 was a broad piece of federal legislation passed by Congress to help reduce the growing federal budget deficit by making substantial changes to tax laws and federal spending. It was part of a series of budget reconciliation measures used to streamline the legislative process and implement fiscal policy changes more efficiently. One of the most notable components of this act was the Foreign Investment in Real Property Tax Act, FIRPTA, which addressed concerns about foreign investors avoiding U.S. taxes on real estate gains. The act marked a significant shift in U.S. tax policy by ensuring that foreign entities were subject to U.S. taxation on the sale of U.S. real property interests, closing a major loophole and laying the groundwork for more balanced treatment of domestic and foreign investors. Before FIRPTA, non-resident aliens and foreign corporations were largely exempt from paying U.S. taxes on gains from selling U.S. real estate. A non-resident alien is an individual who is not a U.S. citizen and does not meet the IRS's residency requirements, like the green card test or the substantial presence test. In other words, they, live outside the U.S. most of the time, may still earn income from U.S. sources, like real estate, investments, or business, are generally subject to different tax rules, especially for U.S. source income. Example: a citizen of Germany who owns a rental property in Florida but lives in Berlin full-time. A foreign corporation is any business entity organized under the laws of a foreign country, outside the U.S. These companies are considered foreign for U.S. tax purposes and are typically taxed only on their U.S. source income or required to file special forms and may have withholding obligations if they earn income from U.S. activities. Example: a Canadian real estate company that buys and sells property in California. Why it matters, especially with FIRPTA. Both non-resident aliens and foreign corporations are subject to special U.S. tax rules, including FIRPTA, which ensures they pay taxes on gains from U.S. real estate transactions. Without FIRPTA, many foreign sellers could avoid paying capital gains tax simply by being outside U.S. jurisdiction. FIRPTA closed this loophole by treating the gain on the sale of U.S. real property by foreign persons as income that is effectively connected with a U.S. trade or business and thus subject to U.S. taxation. Define key terms: withholding tax, foreign person, real property interest. Withholding tax in real estate refers to the mandatory amount of money that must be withheld from the sale proceeds when certain types of property transactions occur, most commonly when a foreign person sells U.S. real estate. Under laws like the Foreign Investment in Real Property Tax Act, FIRPTA, the buyer is required to withhold a portion of the total sale price, typically 15%, and send it to the IRS as an advance payment of the foreign seller's potential capital gains tax liability. This system ensures that the U.S. government collects taxes that might otherwise go unpaid, especially since foreign sellers may not file a U.S. tax return or could be outside the IRS's enforcement reach. Withholding tax is not the actual tax owed, but rather a prepayment or guarantee that the appropriate tax will be paid. The foreign seller can later file a tax return to claim any refund due if the amount withheld exceeds their actual tax liability. What constitutes a person as a foreign person? Example: Maria is a citizen of Spain who lives in Madrid and does not hold a U.S. green card or spend significant time in the United States. A few years ago, she purchased a vacation condo in Miami, Florida, which she uses for a few weeks each year and occasionally rents out to tourists. Now, Maria has decided to sell the condo. Because she is a non-resident alien, a foreign person under U.S. tax law, the buyer of her property is legally required to withhold 15% of the sale price under FIRPTA and remit it to the IRS, unless Maria qualifies for and receives a withholding certificate to reduce that amount. You should understanding the risks for brokers, buyers, and licensees when dealing with a non-resident alien seller is crucial in FIRPTA transactions. When a seller is a non-resident alien, brokers, buyers, and licensees face significant legal and financial risks under the Foreign Investment in Real Property Tax Act, FIRPTA. The biggest risk lies with the buyer, who is legally responsible for withholding and remitting 15% of the sale price to the IRS. If the buyer fails to do this, even unknowingly, they may be held personally liable for the full amount that should have been withheld, plus penalties and interest. Real estate brokers and agents are not typically financially responsible for the withholding itself, but they carry risk of liability or disciplinary action if they fail to identify the seller's foreign status or fail to inform the buyer of their FIRPTA obligations. In some cases, licensees may be accused of negligence or misrepresentation, especially if they improperly assure parties that no withholding is needed. This is why it's critical for brokers and agents to perform due diligence, request appropriate documentation, like a W-9 or W-8 BEN, and advise buyers to consult with a tax professional or attorney. Even a simple oversight, like assuming a foreign seller is exempt, can trigger serious consequences for all parties involved. Here's a real-world example illustrating the complexities and potential pitfalls associated with FIRPTA, Foreign Investment in Real Property Tax Act, compliance in real estate transactions. Case study, Gilbert v. United States, 2021. In the case of Gilbert v. United States, the plaintiffs, Eric and Audra Gilbert, entered into a contract to purchase real estate from Namaka Management Limited, a foreign entity. Upon realizing that FIRPTA required withholding a portion of the sale proceeds to cover potential U.S. tax liabilities of the foreign seller, the Gilberts sought a declaratory judgment asserting that such withholding would breach their real estate contract. However, both the District Court and the Ninth Circuit Court of Appeals dismissed the case, citing the Declaratory Judgment Act's prohibition against court declarations concerning federal tax obligations. This case underscores the legal complexities buyers may face when dealing with foreign sellers and the importance of understanding FIRPTA requirements to avoid unintended legal disputes. Justia Law. Case study, Title Company penalized for FIRPTA noncompliance. In another illustrative scenario, a regional title agency operating across multiple southeastern states faced significant penalties due to FIRPTA noncompliance. The agency, which closed approximately 2,800 transactions annually with about 5% involving foreign sellers, failed to properly withhold and remit the required FIRPTA taxes in several instances. As a result, the IRS imposed a penalty of $387,000 on the title company. This case highlights the critical role that closing agents and title companies play in ensuring FIRPTA compliance and the substantial financial risks they face if they neglect these responsibilities. American Land Title Association. These cases emphasize the importance for all parties involved in real estate transactions, buyers, sellers, brokers, and closing agents, to be vigilant about FIRPTA requirements. Noncompliance can lead to significant legal and financial consequences, making it imperative to seek appropriate legal and tax advice when dealing with foreign persons in U.S. real estate transactions. What might be some red flags that arise when dealing with FIRPTA requirements? Spotting red flags early can save buyers, brokers, and agents from costly mistakes in FIRPTA transactions. Here are some common red flags that could indicate FIRPTA withholding may apply, or that trouble is brewing. Red flags. When dealing with FIRPTA requirements, 1. Seller provides a foreign address or passport. O. If the seller lists a non-U.S. address or presents a foreign passport without a green card, this is a strong indicator they may be a non-resident alien. 2. Seller refuses or delays completing IRS Form W-9. A U.S. person will typically provide a W-9 with a valid taxpayer identification number, TIN, Delays or refusal might mean the seller is foreign and trying to avoid withholding. 3. Seller provides a W-8 BEN instead of a W-9. O. The W-8 BEN is the form used by foreign persons, which often triggers FIRPTA requirements. 4. Seller insists there's no need to withhold. O. If a seller claims FIRPTA doesn't apply without documentation, like a withholding certificate from the IRS, this is a red flag. The buyer is liable if withholding is skipped improperly. 5. Property was purchased by a foreign entity or trust. O. If the seller is a foreign corporation, trust, or partnership, FIRPTA likely applies, and extra due diligence is needed. 6. Title company or closing agent is unfamiliar with FIRPTA. O. A lack of experience or awareness from closing professionals increases the risk of mistakes, delays, or noncompliance. 7. Deal is being rushed or pressured to close quickly. O. FIRPTA withholdings can take time, especially if the seller is applying for a withholding certificate. Rushed deals may result in skipped steps. 8. Seller has no U.S. tax history or records. O. Foreign persons often won't have a U.S. tax return history or Social Security number, which could make it harder to resolve withholding disputes. 9. No mention of FIRPTA in the contract or escrow instructions. O. FIRPTA should be clearly addressed in transaction documents. If it's missing, someone might be trying to avoid dealing with it, or just doesn't know the law. 10. Buyer is unaware they are the withholding agent. O. A buyer who doesn't realize they are responsible for FIRPTA compliance is a huge red flag. Ignorance won't protect them from IRS penalties. Brief historical background on international investment in U.S. real estate. Key features, 1980s. FIRPTA imposed a withholding requirement. The buyer of a U.S. real property interest from a foreign seller must withhold a portion of the gross sale price, initially 10%, and remit it to the IRS. This was a mechanism to ensure compliance, since foreign sellers might not file U.S. tax returns. 1990s. Clarifications and expansions. Various IRS regulations and notices clarified. O. Definitions of a U.S. real property interest. O. Exceptions to withholding, e.g., sales under $300,000 where the buyer intends to occupy the property. O. Procedures for foreign sellers to apply for withholding certificates to reduce or eliminate the amount withheld if the actual tax owed would be less. Primary regulation. 26 U.S. Code, Parv 897. This is the core section of the Internal Revenue Code introduced by FIRPTA. O. It states that gain or loss from the sale of a U.S. real property interest, USRPI, by a foreign person is taxable as if it were income connected with a U.S. trade or business. O. It defines a USRPI as real property located in the U.S., including land, buildings, mines, crops, timber, etc. Any interest, other than solely as a creditor, in a U.S. real property holding corporation, USRPHC. A U.S. real property holding corporation, USRPHC, is a corporation, either domestic or foreign, that primarily holds U.S. real estate assets. Specifically, a corporation is classified as a USRPHC if more than 50% of its assets, by fair market value, consist of U.S. real property interests, USRPI, at any time during a look-back period of 5 years ending on the date of the sale or disposition. This classification matters because under FIRPTA, a foreign person who owns shares in a USRPHC is treated as if they are directly holding U.S. real estate. So, when they sell those shares, the gain may be subject to U.S. tax, and the buyer may have to withhold under FIRPTA. However, there are exceptions, such as if the foreign person owns less than a certain percentage, generally 5% or 10% of a publicly traded USRPHC, their shares may not be treated as U.S. real property interests. Key IRS regulation, Treasury regulation, paragraph 1.897(1) through paragraph 1.897(9). These IRS regulations provide detailed guidance on O. What qualifies as a U.S. RPI. O. How to determine if a corporation is a U.S. RPHC. O. Exceptions, look-back periods, and ownership thresholds. A related IRS notices and guidance. Notice 8985 explains how and when to classify a corporation as a U.S. RPHC, U.S. Real Property Holding Corporation. Revenue Ruling 9132. Though not exclusively about FIRPTA, it impacted how gains from partnership interests with U.S. real property are treated. IRS Forms and Instructions, O Form 8288 and 8288A, Withholding and Reporting Forms, O Form 8288B, Application for Withholding Certificate. These forms and their instructions help interpret how FIRPTA and U.S. RPI rules are applied in real-world transactions. Summary. In short, a U.S. real property interest includes not only physical property, land, and buildings in the U.S., but also certain ownership interests in corporations or entities whose assets are primarily U.S. real estate. If a foreign person sells such an interest, FIRPTA applies and the buyer must withhold. 2004, American Jobs Creation Act. Introduced some procedural refinements, including O penalties for failure to withhold, O clearer rules for domestically controlled REITs, real estate investment trusts, which can be exempt from FIRPTA for some foreign shareholders. A REIT, or Real Estate Investment Trust, is a company that owns, operates, or finances income-producing real estate, like apartment buildings, shopping centers, office buildings, or hotels. REITs allow everyday investors to buy shares and earn income from real estate without having to buy property themselves. By law, REITs must pay out at least 90% of their taxable income to shareholders as dividends, which makes them a popular choice for income-focused investors. They are often traded on stock exchanges like regular stocks and offer a simple way to invest in real estate markets. 2015 PATH Act, Protecting Americans from Tax Hikes Act. A major FIRPTA update, O increased withholding rate from 10% to 15% for most transactions. O encouraged foreign investment in U.S. real estate via publicly traded REITs, exempted certain foreign pension funds from FIRPTA, expanded exceptions for foreign investors holding less than 10% of a publicly traded REIT. These changes were aimed at modernizing FIRPTA and encouraging foreign investment, especially in commercial real estate. 2020's Continued Application and Enforcement. FIRPTA continues to be a key tool in ensuring foreign sellers of U.S. real property pay appropriate U.S. taxes. Real estate agents, escrow companies, and tax professionals must stay diligent about withholding compliance. The IRS continues to update forms and instructions, e.g., Forms 8288, 8288A, and 8288B for withholding and certificate applications. Today, 2025, FIRPTA remains a critical piece of tax law impacting O foreign investors in U.S. real estate, O buyers of property from foreign sellers, O title escrow agents, real estate attorneys, and agents. Awareness of exemptions, proper documentation, and timely filing remains vital to avoid hefty penalties,